Chapter 32, RSI, Stochastics, and Bollinger Bands. RSI, Stochastics, and Bollinger Bands all help you identify extreme price movements in stock price. With this information, you can enter a trade at its most extreme downswings and exit towards the top with a technical background and basis behind your positions. These indicators help you increase your trading consistency, especially while swing trading, by allowing you to easily play off trending or sideways environments with identifiable minimum and maximum prices. J. Wallace Wilder developed the Relative Strength Index in 1978. The indicator compares recent gains to recent losses, looking for oscillating differences in magnitude. Wilder recommends using the 14-period RSI, and this is by far the most popular increment used today. To calculate the RSI, use the formula 100 minus 100 divided by 1 plus RS, where RS equals average gain over average loss, and for a 14-period RSI, the initial RS is the sum of gains over the past 14 periods divided by 14, divided by the sum of losses over the past 14 periods divided by 14, and for a 14-period RSI, subsequent RS values equal the previous average gain times 13 plus current gain divided by 14 divided by the previous average loss times 13 plus the current loss divided by 14. This equation gives you a number between 0 and 100. RSI is traditionally considered overbought when above 100 and oversold when below 30. In other words, the stock will probably go down when the RSI is extremely high, and it will probably go up soon when the RSI is extremely low. Yahoo Finance and other modern trading platforms extend RSI extremum values to 80 and 20 for more pronounced indications of overbought and oversold territory. When RSI passes 80, consider selling. Inversely, consider buying when RSI hits 20. RSI often lags behind tops and bottoms more so than other indicators in long-term setups. Just as with stochastics, you may see extended periods of high RSI levels before a stock comes back down. Bollinger Bands can help you find extreme peaks when a stock's RSI indicates overbought territory. With that said, oversold RSI levels often prefaces more immediate price movement. Let's look at an example with Toll Brothers Inc. to highlight this principle. Then we see Toll, and the RSI is their only indicator on the bottom there, and we see some consistent bottoms in Toll that correlate to bottoms in an RSI movement subsequently at the same time. Especially in the 2004 to 2005 Toll run-up, we see extended RSI levels telling us to sell. However, prices keep rising after a quick drop in the RSI, showing that the stock had more momentum left. To lower your risk when making trades based on RSI, try waiting for the indicator to drop back below 80 when overbought or above 20 when oversold to confirm a movement reversal. In this example, the default RSI is relatively stable and presents only a few compelling buying and selling opportunities. To see more volatility in the underlying stock, we can decrease the RSI period to only 2, resulting in the following graph. Now we have a much more oscillating RSI indicator, and it shows a lot more overbought and oversold periods in this given time frame for Toll. Now, we see significantly more buy and sell signals since the smaller price movements greatly affect the RSI. Combine the RSI with other indicators to confirm the best entry and exit opportunities for your trades. RSI, stochastics, MACD, and more can all indicate reversals through divergence. Divergence occurs when oscillating indicators trend in the opposite direction of the underlying stock price, as opposed to convergence when the indicator follows the trend direction and show strength. Prices may diverge upward while MACD and RSI trend downward, or vice versa. This often occurs in movements when the price is already extremely high or low, and the indicator often tries to return to normalcy. Although this movement is slightly rare and often short-lived, you can use it to strengthen your analysis when you see extreme oscillation to forecast reversal patterns in your stocks. Here's an example of divergence with McDonald's Corporation. Notice that it takes a while for the setup to actually complete and break below the resistance as the MACD and RSI trend opposite to price movements. There can still be significant gains in position after the RSI indicates an oversold condition if other market factors keep pushing the stock. Then we see McDonald's and a very good long-term upward trend till it broke out of it, and it broke out of it after a long-term divergence on that RSI indicator shown above and the MACD indicator shown below. As the prices increased, these two indicators decreased. And you can tell that just by connecting the previous highs on the indicators and the previous lows on the stock. As soon as the stock shows weakness toward the end of this divergence, McDonald's crashed through its support and found new lows. Even if you missed a breakout in a divergence movement like this, you can still use subsequent bottoms as great buying opportunities. If you are in the position during the divergence and looking for times to sell, watch for indicators crossing their midpoints. If you do not get in a trade at an extreme RSI value, especially watch indicator midpoint values. You'll likely see quick reversals if the RSI shoots through 50 and leaves its midpoint behind. Stochastics, created by George Lane, are an extremely accurate indicator when you use it in a stock's historically proven effective interval range. The indicator stands as a favorite indicator to many because of its high accuracy. Stochastics combine extremely well with other indicators and work splendidly on their own to help you find the best place to enter and exit a trade. The indicator uses two lines plotted along a 0 to 100 oscillation chart similar to the RSI with extremes at 80 and 20. To find the quicker K stochastics line, black by default in Yahoo Finance, use 100 times current closing price times lowest low in look back period divided by highest high minus lowest low, both in look back period. To find the slower D stochastics line, red by default in Yahoo Finance, use closing K line value for look back periods including most recent K value divided by number of look back periods. The default look back period for the K line is 14 periods. This value keeps your stochastics accurate and prevents false signal lines while still showing you setups as they arise. This default look-back period for the D line is 3 periods. Because the D line is a simple moving average of the K line, it's slower than the K line. You can use the speed difference to spot crossovers in the stochastics lines just as with MACD lines to indicate potential price reversals, especially at extreme values below 80 and over 20. With these critical levels, stochastics measure up toward upward and downward momentum to help you predict price reversals. As with all other indicators, the time span for stochastics changes as you change the length of individual candlesticks, and longer time spans generally predict stronger results and trends. Let's look at an example with Newell Brands Inc. using stochastics, RSI, and 50 and 200 moving averages. And there's a chart of Newell Brands, and we can see the stock historically bounced off of the 200 moving average. And after there was a cross of the 50 and 200, there was a death cross. The thing went down for a long time, and then just recently it's had a golden cross, but a substantial downtrend with extremely low stochastics and comparatively low RSI values. In the monthly chart, notice two primary lower stochastic patterns. First, you can see quick downtrends followed by rapid bounces back up, presenting you with tremendous buying opportunities. In stochastics, this shows up as a quick drop and seemingly immediate bounce off the 20 level. Then, there are slower downtrends that gradually decrease stochastic. In times like 2000 and 2008, Newell stayed under the 20 stochastics level for a while until prices started to rally back up. For a conservative entry into an order like this, wait for the underlying stock to clearly and deliberately reverse enough to bring the stochastic straight through the 20 level, rocketing back towards a midpoint pivot at the 50 stochastics level. Alongside great buying opportunities when stochastics are low, you can also find good selling opportunities when stochastics are high. With that said, stochastics often stay high during extended rallies, signaling that you might want to wait for the stock to cool off before entering a long position. If you're already long or looking to take a short position, watch for the stochastics to crash back below the 80 level after a run-up. High stochastics often persist through big bull runs. As stochastics eventually break below the 80 level, you want to watch for the appropriate approach to the mid 50 level again to indicate impending downtrends. To see this especially with the initial 1999, 2007, and 2017 drop in Newell. Here's a short-term example on a larger stock to demonstrate this principle. We see in Macy's the 20 band broke through, there was a buy signal, and then the 80 band crashed down through the 80, and there's your sell signal. If you're a little more conservative on a trade like this, you can wait for that 20 to go across the 20 and then go to the 50, which is that midway mark, and you'll still get just a little bit worse fill, but a pretty solid price entry, and you'll still be able to partake in that uptrend and the overall gains. And if you wait to go to the 50 to sell, you're still just going to get a little bit less money out of the trade, but a significantly safer position, and you're allowing yourself to stay in that trade if it accidentally goes back up and has higher gains. Just look for really solid setups that look very continuous, and then you're going to have continuous profits. Alongside the stochastics crossing the 20, 50, and later 80 level, notice how fast the faster K line breaks through the D line almost perfectly at the top of the bottom of this movement in M, just like the MACD crossover. Furthermore, here's one last example with 1-800-Flowers.com Inc. And then you can see the stock is just killing it, and then stochastics on the bottom show overbought, oversold territories, and as we will see in just a minute, almost every single bottom in the weekly stochastics correlates to a swift reversal in the market, while the biggest downtrends come at the end of an extended high stochastic streak. Combine stochastics with other indicators, moving averages, and more to find opportune times to enter and exit a position. Remember, the stochastics can remain overbought and oversold for an extended period. Look at the stochastics of a stock you are considering and see how it historically performed at high and low stochastics levels. When looking for divergence in stochastics, you will likely find the most success when an indicator is near an extreme 20 or 80 value, as shown below. Then we see the stock trending downwards, whereas the stochastics actually has higher lows, so it's trending upwards. That would be bullish divergence, since you're looking at prices going down, but the stochastics go up. Like with all oscillating indicators, drawing lines when you see a potential indicator trend and correlate them to support and resistance levels, trend lines, in the underlying stock. A slight variation of stochastics is stochastics RSI. Rather than the actual stock price, stochastics RSI is based on the stochastics of a stock's relative strength index. You can generally use stochastics and stochastics RSI interchangeably, though stochastics alone tend to be more accurate since it tracks the actual underlying stock price. However, some platforms use stochastics RSI in place of stochastics, so just know that they work approximately the same. Stochastics RSI often moves slightly faster than stochastics, as shown below. In the end, stochastics RSI mimic stochastics to an extreme. And then we actually see a Forex chart here comparing the euro to the US dollar. And over time, we're looking at the RSI, the stochastics RSI, and the stochastics in the middle, then stochastics RSI on the bottom. And you can see the RSI correlates to the stochastics, and then the stochastics RSI is just a little bit more of an extreme version of the stochastics. It's really going to bottom out quicker and stay topped out a little bit more smoothly, so it's just a little bit smoother. Most of the time, though, you're going to see just about the same performance from the two, especially as you look at larger time periods with more zoomed out time frame. From the highest to lowest chart elements, we see the standard candlestick chart, RSI, stochastics, and stochastics RSI. Stochastics RSI can stay extremely high or low for extended periods until a stock eventually pulls back or runs up, like with traditional stochastics. Time frame changes drastically alter stochastic perspectives. Decrease your candlestick reference length to find more immediate opportunities, or increase said data to identify swing trade movements. Lastly, we get to Bollinger Bands to identify and profit from extreme price movements and trend volatility. John Bollinger created Bollinger Bands in the early 1980s. You can calculate the three lines in the Bollinger Bands by using the equations middle band equals simple moving average, F, or period N. Lower band equals middle band minus period N standard deviation times number of desired standard deviations. Upper band equals middle band plus period N standard deviations times number of desired standard deviations. The default values in Yahoo Finance are 20 for the simple moving average and 2 for the number of standard deviations. These are the Bollinger Bands values most traders use, and they have historically proven reliable. You can change the moving average look-back period and number of standard deviations to further restrict volatility movements in the Bollinger Bands if you see few trading signals with standard settings. Bollinger Bands adapt to price action volatility by expanding and contracting because they are built around constantly changing standard deviation bands. Volatility decreases as the upper and lower bands near the central moving average. Price changes slow down due to low volume or perhaps complacent investor sentiment. Periods of low volatility are frequently followed by periods of high volatility in either the upside or downside. As the Bollinger Bands squeeze together, stretch out, and repeat, you can see constantly changing volatility in an underlying asset, as shown below in Brent crude oil. And then we see Brent crude oil. It had a pretty decent trend. It was showing downward just a little at the beginning, then it went up at the beginning. And as the Bollinger Band started to get tighter towards the middle of this chart, you can see that the price is really getting squeezed. Those candlesticks are not going to stay put because the Bollinger Bands are so tight with little volatility, little volume. So it tries to break out on the upside, but it goes against the Bollinger Bands, and it just doesn't have the power, doesn't have the momentum to move through it. So as volume increases, it reverses, and then it just rips down the lower Bollinger Band, keeps you along the bottom of it, and as the bottom of the Bollinger Band guides it down, the Brent crude oil just keeps going down and down and down. After a 5-month period of sideways movement and decreasing volatility, the market finally tested the upper region of Bollinger Bands, signaling an impending increase in volatility. After this test failed, Brent crude went through a rampant 3-month sell-off of increased volatility. The tight Bollinger Bands for this 5 months prior rapidly expanded as the market radically adjusted its price point on Brent crude. When you notice prolonged periods of low volatility in Bollinger Bands, be prepared to place your bets when the stock starts moving again. You can look especially for prices to continue in the direction of a previous trend. In the example above, Brent crude oil had a long downtrend prefacing this movement. If you're unsure about where a movement might go, simply wait for the first decisive initial breakout, like with a symmetrical triangle pattern. In strong downtrend or uptrend, prices can continually run along the Bollinger Bands as buying or selling remains strong. You can predict a trend reversal once prices start falling away from extreme values, perhaps falling back towards moving averages. Watch especially for prices bouncing off the edge of the Bollinger Bands into the central moving averages as a sign of slowing trends. If the price does not bounce back away from this average, then the stock may finally reverse. Here's an example with BlackBerry Limited. Then it shows a chart of BlackBerry, and there's some really quick movements. And as it breaks, towards the bottom of the Bollinger Bands at the beginning, you see Stochastics bottom out, and it just has a huge downtrend. But then the Bollinger Bands tighten up, breaks out of the Bollinger Bands, huge upswing, and the thing just goes sideways from there until it goes outside of those Bollinger Bands again. Stochastics show minimum movement. It's got very high sell signals, goes to the bottom until it finally bounces up, and then it crushes it as a huge gain, very high stochastics, and it just keeps trending up at the top of those Bollinger Bands. Notice that BlackBerry actually breaks out of the Bollinger Bands during many movements from 2013 to 2015. This extreme move often leads to a rapid correction, although this may not be an extreme correction if there is enough momentum in the movement, as shown in BlackBerry's 2014 initial pop out of the Bollinger Bands. However, sustained breakouts of the Bollinger Bands later in an upward movement after an already large move may showcase the end of a movement, as shown above in the early 2014 before the formation of a W pattern. Two distinct patterns that form in the Bollinger Bands are the M and W patterns. M's and W's play off support and resistance levels just like many other price setups, but they also respect and bounce off Bollinger Band trend lines. Below, you can see an M setup in ExxonMobil Corporation. Then we see here there's a M top at the top of the Bollinger Bands as the stock goes up, but then it goes back down to that support level, then goes all the way up to the top of the Bollinger Bands again. It's complete the M, downtrend, break the support, and then have a continuing downtrend after that as it exits the M setup. And then you can see also bearish divergence in the MACD at the same time. Very, very cool stuff. Notice that XOM nears the upper band on its second M run-up, but it lacks the momentum to break through. As it breaks its lower M support line, the trend reverses, and rather than trading at the top of the Bollinger Bands, the stock crashes along the bottom and even drops out of the Bollinger Bands as the momentum slows and the MACD bottoms. As the chart points out, there was also a bearish MACD divergence while the M formed since prices increased while the MACD decreased, further strengthening the impending downtrend. Contrary to the M setup, you can use the W pattern to spot impending uptrends. Here's an example with Nordstrom Inc. So here we see the price downtrends, goes down, hits that Bollinger Band, bounces off to that midpoint line, and then back down a lower low at the Bollinger Band again, but it comes back up. And that's when you complete the W setup, and then it goes into that resistance line, breaks out of the resistance line, and trends upward alongside the impending Bollinger Band. So it just keeps going up, and the volume just spikes because it's breaking out and it's going up to those higher W setups. The goal with W and M patterns is to wait for the stock to break through its respective support or resistance. Unlike head and shoulder setups where you can skillfully time the second shoulder, these Bollinger Bands reversal patterns are less set in stone. As this chart, along with many other you've seen show, a stock can rally along the bands in a downtrend, even breaking out of them with extreme momentum or lack thereof, before reversing price action. In this example, we see decreasingly less volume in the market after the W pattern completes in JWN, as fewer investors want to purchase the stock while it rallies near the top of the Bollinger Bands. The uncertain price action in JWN only attracts big spikes in volume and, therefore, market participants when it touches the W resistance line, breaks through the resistance after bouncing off the Bollinger Bands, and eventually breaks out of the Bollinger Bands to newfound highs. Look for selling and cover opportunities as the stocks break outside of the Bollinger Bands for maximum profits. You can also use the Bollinger %B and Bollinger Bandwidth indicators to show volatility and potential divergence. By default in Yahoo Finance, these indicators use the same standard 20-period moving average and 2 standard deviation calculations as the Bollinger Bands. Here's an example showcasing Bollinger Bands, Bollinger %B, Bollinger Bandwidth, and moving averages in Carvana Co. Here we see Carvana, super huge run up as it goes against those Bollinger Bands, and then high Bollinger %B when it's at those high levels and it's breaking upward to new highs, and at the same time the Bollinger Bandwidth increases during large uptrends, as those are periods of the highest volatility since it's pushing up against those Bollinger Bands. Besides simply seeing Carvana pop out of the Bollinger Bands, the Bollinger %B graphs the stock price in relation to the Bollinger Bands by using an adaptation of the Stochastics formula. So you can watch for continued %B breakouts above 100% of the Bollinger Bands, aka when the stock has an extreme upward movement, to indicate strong momentum behind a stock, forecasting higher future trends. You can see this in Carvana as it runs from just over $10 to $70 within a year, consistently breaking above the Bollinger Bands and respective Bollinger %B. As we look into the future, we see more minimums in the Bollinger %B as prices quickly drop to a strong support around $35. Continued %B lower breakouts show a lack of momentum and could predict downward price movement. On top of this, we see the daily 50 moving average quickly approach the 200, forecasting a potential death cross. Lastly, you can see a head and shoulders setup in recent months. Both of these indicators, immediate bearish predictions, are further supported by the Bollinger Bands. Lastly, the Bollinger Bandwidth shown at the bottom of our Carvana chart showcases volatility by measuring the width of the Bollinger Bands. High values and peaks here indicate large momentum and volatility, as you can see in the increasing size of the actual Bollinger bands and subsequent moving average standard deviation. In periods of low volatility, look out for divergence in the Bollinger %B. The Bollinger Bandwidth indicator, with its default parameters, is 4 times the coefficient of variation. You can effectively use this to find volatile periods and predict future volatility after very calm periods without looking directly at the Bollinger Bands. For reference, you can calculate this coefficient using the equation coefficient of variation equals standard deviation of price divided by average price. You can also use this calculation with an asset's historical return and standard deviation to find a position's risk relative to its return. For a higher standard deviation, aka taking on more risk, you should expect to receive higher returns. This will make your coefficient of variation lowest for assets that reward you the best for taking the risk level you take. This calculation is especially useful when comparing long-term bond or marketable funds. As an example, here are some coefficients of variation for 3 major indices tracked by ETFs. Lower coefficients of variation show better risk to return payoffs. The S&P 500 has a standard deviation of 14.68% divided by an annual return of 5.47%, which gives a 2.684 coefficient of variation. Similarly, the PowerShares QQQ ETF has a standard deviation of 21.31% with an annual return of 6.88%, which gives a coefficient of variation of 3.097. Lastly, the Russell 2000 ETF has a standard deviation of 19.46% with an annual return of 7.16%, which gives a coefficient of variation of 2.718. Using a 15-year look-back period for all of these, year 2018. You can find significantly higher returns with more volatile positions, but you must be cautious of potential downsides and adapt accordingly when market sentiment shifts to maximize your returns. It is very difficult to time overall markets, but stay aware of macroeconomic factors that could influence your long-term portfolio value.